Hey everybody, this is your man Jason Myles, and
Hey, this is Steve Connolly, sometimes known as hashtag unemployable.
that's right. And today, you guys, we're going to talk about the real estate of the union for 2022, right? We're going to talk a little bit about what it was and a little bit about where we're going so you can have a pretty good idea of what it is you want to do, right, Steve?
Absolutely. We need to know what has happened, what is happening, and what's going to happen, to the best of our ability in terms of what's going to happen. No one can tell the future, of course, but let's be prepared.
That's
That's the
right.
old Boy Scout motto, be prepared, right?
That's exactly right. So, you guys, you want to probably take some notes so you can kind of get your thoughts in order. So, get yourself a pen, paper, your voice recorder, in your notes, and we'll be right back to share this information with you as we see it. Boom. Thank you guys for sticking with us. And welcome again to the Real Estate 360 show, the podcast, right? So make sure that you share this with people. And for all you guys that have been viewing and downloading and sharing, thank you so much. We really do appreciate you because we can see the growth on our end. So please keep sharing. And if you find value in it, of course, we want you to share and talk about it and engage with us. Tell us what you think because, we have what we believe to be the truth, our opinion, and then there are facts which continue to be taken in all kind of different ways, which we're going to talk a little bit about today, right, Steve?
Absolutely. Some of them are facts and some of them are going to be predictions and opinions and viewpoints, but all of it will add to the whole, and we'll come out with a better picture of what to do next, what to do now, what to do, what's coming up, and it's going to be exciting.
That's right.
Change equals opportunity.
All the time, all the time,
Yeah.
and when we're talking about the state of real estate, the real estate state of the union, right? And we need to understand what this is today more than ever. Um, Steve, as you and I were talking about before the show, there are more millionaires than there have ever been in America, really around the world. But we're kind of focused on America. I don't know if you guys knew that, but we're kind of focused on the U.S., right? So, but a lot of these new millionaires came out of that 2008 financial crisis that we had. And so their idea about money is a little different. Their belief system about money is a little different. How they can earn it is different today than it was in 2008. Look at all the internet millionaires. I hesitate to call them .com millionaires, but the internet millionaires. You know, they have made their money in a way that for a lot of Americans it seems like a fantasy. But again, all you have to do is look on social media to see how they're spending that money. And they're not really preparing a lot of us, not just those new millionaires, but it's those new millionaires that are gonna in the future, they're the ones that are gonna dictate policy, right? Because that's
Hmm.
where the money is. The money is with them, and where the money is where policy gets dictated, as we can see in our current, geopolitical climate, which we'll just kind of tiptoe around, But wherever the money is, has a tendency to, depending on who's in office, as you stated earlier, has a tendency to pull the strings. So, seeing this class of people, these younger folks, let's just say, they're you know in their mid at the latest in their mid 30s, right? These millennials at the latest in their mid 30s, mid to late 30s. And when the crash happened, we're talking 14 years ago. A lot of them were in high school. A lot of them were younger
Hmm.
than that. Some of them were in
Yep.
college, and their lives changed, and their family lives changed. And it stands to reason that how they think about money, and specifically money as it relates to home ownership or real estate as a whole, they think about it very differently than we do.
That's right. And when we were talking about that, and you said there's more millionaires than ever, of course, that's true. And the first thing that I thought of was, the million today is not worth as much as the million 14, 15 years ago,
Mm,
or 30 years ago. And as we move forward in time with what's happening with the quantitative easing and the Fed buying back their own bonds, and creating, the significantly higher supply of money, what that does, that reduces the value of every dollar that we have. So $1 million today is just not worth what it used to be. Now, don't get me wrong, $1 million is still, a good sum of money, but you can blow through a million pretty quick,
yeah, really quick, especially with the inflation that we have today. And I want to share a clip with you. You know, I like to look at what all of the quote unquote gurus, and I don't mean that in a negative way, but the people that have made a ton of money off of real estate and other things, how they think about it and what they see. And I was watching this Robert Kiyosaki clip, and I wanted to share it. So let me play this for you so we can get your take on it. Okay.
Okay.
So there's all kinds of things going on in real estate today, but it'll eventually crash simply because the government is making it so expensive to build a house.
Right. And so now we come right back into a situation where, you know, here's a guy who's made a ton of money off of real estate, is making a ton of money off of real estate, will continue to make a ton of money off of real estate, talking about a thing that touches us as flippers or even new construction people, but it's different for the big boys, but it touches us in a really intimate way. I mean, we've known what the values were for our materials for years, and we can handle, moderate ups and downs. But when you see, materials tripling in price, literally tripling in price, it really throws a monkey wrench in your ability to fix and flip a house, right?
Yes, it does. And Kiyosaki's been around for a while, and he's certainly made a good bit of money in real estate, and that's one of his cornerstones. You and I have been around for a while, and we have seen the cycles. What spikes up is generally going to spike down at some point. So, we're going to be looking, we think, at a correction. And, with the politics these days, it's gotten a little bit crazy, I think. I don't think I'm stepping too far out of the boundary to say, hey, it's nuts out there.
Mm-hmm.
And and what I have noticed over my 30 or so plus years in real estate and 40 or so plus years in businesses, and this is speaking from an entrepreneur's perspective, not an
Mm.
employee,
Right.
not somebody who's going to go every day to work and get their paycheck. But from an entrepreneur's point of view, it just gets more and more difficult to do business and make money when there's a Democrat controlled, basically government. It's just harder. When you get the Republicans in there, they start loosening some of the restrictions and the controls, and it gets a little bit easier. But that said, overall, what's going on in the state of the real estate union,
Well, you
and
really
what's going to
brought you really brought a real solid point there, because when we see Democratic, um, you know when everything is Democratic,
policies?
right? When exactly these policies, the interest rates are going to go up. We know that it always does. Money winds up being stagnant and sitting on the sidelines, waiting for different kind of opportunities. Because, contrary to, I hesitate to even say popular opinion, in a Democratic office, things seem to slow down quite significantly, and we as entrepreneurs have to find, different ways to maneuver inside that. You know, we just came out of a Republican um, office where interest rates were really low. Just talking about business, okay? Forget all of the minutia, all the extra stuff. Just talking about
Please.
business, right? Interest rates were low. It was easy to do business, relatively speaking, that is. But now
Mhm.
we're going to start to see some of those corrections, and rightly so. We need to see some of those corrections. But I want to go into another clip where I believe this clip is by Ken McElroy, um, about a little bit about what those low interest rates look like.
So we have the Fed just announced they're going to keep interest rates low for about 5 more years. But that means my generation, we're screwed because Wells Fargo is not going to pay a dividend. For pensions to operate, you need about a 7% return. And because they suppressed the interest rates, just like they suppressed COVID, what a fake that was. But they suppressed interest rates and they suppressed COVID. It kills everybody. It's killing everybody.
That's right. You know, we've been in a situation where rates have been suppressed. We've kept them low, for one reason or another. I mean, there was an argument when we had Trump in office. He wanted to really push for, negative, zero to negative interest rates, which, most economists globally would say, hey, that's a horrible thing. But we got as close to zero as we could possibly get, right? And we don't live in a banking system where we can put money into the banks anymore and actually make money, right? So it'll
Not at all.
yeah, exactly. But where does that money go? Of course, we know the banks invest that money, but from these big institutional investors that have all that money sitting on the sidelines because they understand this part of the cycle that we're in. Where does that leave the little guy, and what they should know and what they should do in an economic cycle, at least at the point of the that we're in this current economic cycle. What does the little guy to do when they maybe just entered the workforce, and 5 years ago, let's say, and they've been saving up their money or very diligently investing their money to get to a point where, okay, boom, and we're talking about real estate, right? So we're like, okay, we're dipping and dodging. What are we doing? Are we wholesaling? Are we fixing, flipping? Are we buying, holding? Well, for me, anyway, the market dictates which thing we're going to be doing and for how long, right?
Completely. It has to. Um, where a few years ago, frankly, we could run around in certain areas of Atlanta and find as many of the wholesale property transactional deals, if you will. I don't care for the word deals, but single family houses that had enough spread in them in those gentrifying areas that, I mean, we could do as many as we wanted, really, as many
Mm-hmm.
as we could handle. And that's not the case today at
That's right.
all.
Not at all. And that was just a few years ago, you
So
know.
the market's going to dictate what we're doing. So what are we doing?
That's right.
Um,
So, and
and
where are we going? And where are we going? Okay. So I can tell you from my experience, I know that the cost to renovate these houses. I mean, you when you watch your typical news channel, they're going to tell you that there's a shortage of homes, or they're going to tell you home builders are, just killing the game right now, right? But it's getting super super expensive. I mean, they're not going to just eat the increased cost of materials. They're not going to do it. So we're going to see home prices. In fact, did you know that the average home price right now in America is $362,800?
I didn't think it was that high. I thought it was in the 300s, but I didn't realize it was getting close to
Yeah,
400,000.
exactly. It's absolutely utterly insane. So where are we headed? In my opinion, we're going into a rental kind of situation because there are a ton of issues there. But let's check this next clip out.
To home ownership during this time. And what happens when it reverses is they go back into rentals, and that's where we're going to head it in a minute. So as you can see, this all fell here, and here's where we are now. So the home ownership rate is down to about 65% from 68%. While that might not seem like a lot, guys, that's millions and millions of people that are coming out of home ownership into rentals. The second thing, interest rates, they're going up. Let me show you guys. It's all over the news if you haven't read this. The Treasury Secretary Yellen says that rates may have to rise somewhat to keep the economy from overheating. Things are overheating right now. Prices are going crazy, guys, and the Fed uses the interest rate as a barometer, as a gas pedal and a brake to be able to put the brakes on an economy.
And that is 100% correct. We're looking at home values getting so high, interest rates are going to go up. Of course, we knew they were going to do that. I was expecting at least one rate hike in January, but they opted not to do that. Now, one can say, well, they didn't do it because, of whatever reason. The reality of it is they need people to continue to spend, right? They need to get all of this money that they put out there during the pandemic. They need to rake it back in, because what's going to happen when they rake it back in? If people keep spending, it winds up back into the hands of the government, right? So, and people are going to keep spending. We've seen that. We've seen people just spend monies that they don't even have. They spent borrowed money that the government is going to take back the minute they file their taxes, but
the U.S. economy has converted to a consumer economy.
Of course.
It used to be a manufacturing and production economy. It's not that anymore. It's all services and consumer spending.
That's right.
So
how do you control that, though?
We have to spend the money to keep the economy going.
Yeah, but how does the government and or big business, how do they control that, knowing that that's the case?
Well,
there's only one way they can control it. That's by expanding and contracting inside the walls of the United States of America. So you create inflation, massive inflation. I mean, there's no financial reason, good reason, that there shouldn't have been a rate hike in January to start to slow things down so that we can control this inflation, whether it's, because some people believe it's, it's not real, but it's there. It's real if we feel it at the grocery store, right? So it's real if we feel it at the gas station.
This is not something you and I have talked about, but, I believe that we don't really need to do any rate hikes.
Mm-hmm.
Smith, the economist from the 1800s, said it's all supply and demand. When we get too much supply, the demand is going to go down and the prices are going to go down. When the prices go up like that, demand is going to go down. But people are not going to buy as much because the prices are too high.
Absolutely, but that's when money was money.
That's true.
There was a different value. And I wholeheartedly agree with the supply and demand aspect of it. When money is actually money and it's not currency, it's not a fiat.
Most people have a pretty set income. They're going to be making pretty much the same amount of money this year as they did last year. And if grocery prices go up 20-30%, if housing goes up 20-30%, where's that money coming from? It's not going to be magically appearing in their paychecks. So
no,
they're just going to be spending less.
Well, absolutely, but in an economy like you've just described that we're living in, the consumer one, where supply and demand doesn't matter as much because money isn't money, it's currency and there's a difference. The only way to control that and to allow future growth is expansion and contraction internally. And if you have that expansion, Doesn't matter if it's real or not, because people feel it when there's money flying around, right? Doesn't matter that that dollar is only worth, 80 cents or whatever the case, right? To the person, the boots on the ground, people, regular people, they got a dollar in their hand and they're going to go spend it as far as it'll go. So they're going to do that. And right now, the government is setting up big business and itself to rake money in.
Absolutely.
To rake it in. That's why they did. That's why they didn't raise the interest rates. And when they start raising them in March, they're going to raise them slow. And that's when we have that contraction. That's when we'll see rates go down. That's when we'll see. I mean, not rates. Excuse me. Values.
Demand.
Excuse me. Values. Yeah.
Demand.
Values will
Right.
go down. And that's what we're going to see. I firmly
It
believe
won't
that.
take much. It won't take much of a rate increase to cause that to happen.
No, I mean
You
they're
know,
already putting fear in people right now.
exactly. It's a fear-based economy, really. So what if you raise the rate a quarter or half a point, from 3 to 3.5 or 3.5 to 4? I mean, it really doesn't make that big of a difference in the payment. And of course, the interest rates themselves are what's driving the price of the houses up.
Mm.
And also, the ability for people to buy a $400,000 house at 2% is, much more than, 4% because they're paying twice as much,
Well, let's
at
hear a little
4%.
bit about that. Let's hear a little bit about that. Those construction costs.
And the last thing is construction costs. So those of you who have been under a rock, you know that construction costs are really, really high right now. That's creating affordability issues. As you guys can see, from construction costs, home builders and buyers face high prices due to construction costs that are going up. In fact, the National Association of Home Builders right here, check this out. They've added $35,872 for one house. And so what we're seeing is there's no way the builder absorbs that. There's no way the contractor absorbs that. These costs get passed right through to the homeowner, and it creates more and more affordability issues.
And that's exactly what we were talking about right there, Steve. That is literally what we're talking about, and that's what we're seeing. So you're 100% right. Low interest rates are going to push the values of the homes up. That coupled with this ridiculous increase in material costs, because they're not going to eat it.
Can't.
They simply can't. There's no way they can. And when you look at a builder, they're making anywhere between 13 and 15% profit from the retail number on each one of these houses. So if it's a $400,000 house, best case scenario, they're going to make $60,000 selling that house. Best case scenario. But if they've got a $35,000 increase in the cost to build that house, they're going to start looking at two things, right? They're going to start looking at incentives, and they're going to start looking at increasing prices, which brings up the affordability issue, which we are watching nationwide. Nationally, we're seeing, affordability issues and income discrepancies, so that people can't afford these things, because you're not building, you're not building $200,000 houses anymore. I mean, I don't even know what that would look like. I don't even know what it would look, and we're in the South. We're in the Southeast, where it's generally a lot more affordable to build. I don't know what a $200,000 house would look like today. I mean, it would definitely be a house where the wind would be able to blow it over.
That's a mobile home.
Well, there you have it. There's your Uncle Bob, right? But but you do have these issues, and you made mention of that as well. I mean, look at mobile home parks right now. There is an absolute boom in mobile home parks right now, Steve, because of the affordability issue.
Well, we're in a cycles. It's all cycles. When you've been around for a while, you can step back and see, hey, we're in this particular cycle now. There are nuances to this one that are completely different than anything I've ever seen. And, but, that's what makes it kind of exciting. But here's the thing, we've heard that this is a boom bust economy. And it seems like that the wave patterns of these cycles is getting shorter and shorter. So we boom and we bust and we boom and we bust. So if we're in the boom cycle right now, how long have we been in it, and what's coming next? Maybe a bust. The only question is how much.
That's right.
Right? Every organism has to breathe. I mean, and economies they have to breathe too. You can't just breathe in all the time. You have to breathe out. You know.
And where are the opportunities coming up in
Right.
2022 and beyond? Where are they? I mean, I have my beliefs. I believe for sure that we're moving from an equity acquisition standpoint to a cash flow position because we know we're going to see a correction. And what does that mean? That means for the person that bought a house today for $350,000, I believe by the end of the year that property is going to be worth 320, maybe even 300,
Hmm. A
because
lot of economists disagree with you on that. They say that prices are going to continue to go up this year.
I think they will, but not towards the end of the year. I think that once we start, I think the Fed is going to increase rates. At least they're going to do it twice, maybe three times this year. And if they
Hmm.
do that, we're going to see a major slowdown in home sales because people are going to say, hey, a $350,000 house, in the beginning of the year, or let's say a year ago, my note would have been $1,400. That same $350 or $350,000 house today is going to cost me, $1,500 with the rate increase. That $300 a month is putting me out, puts them out. So what has to happen? If the rates are going to go up, value's got to come down. Has to. And that's going to leave a ton of Americans with potentially negative equity.
That's right. But they'll have a great interest rate. So,
they will.
but
And they have to, it's time. They have to see their way through it. But that creates an opportunity for folks like us, for us investors, when we're looking for that, right? Can I share another clip with you real fast?
can I say one more quick thing?
Yeah, yeah, please do.
In the cycle business, this is starting to look to me like, and I just thought of this, the 80s when, we were in a boom cycle there for a bit, and people were building, or builders were building and converting apartments into condos, and condos were the big rage. I mean, it was
Mm-hmm.
like condo, condo, condo. Well,
Yeah,
then all of a sudden the market kind of dried up on those, and in terms of being able to sell them, and then there was just condos all over the place that could be picked up really, really cheap. To me, it's looking a little bit like that because like I said earlier, we've been in a boom economy. Builders have been trying to build as much as they possibly can, of course, apartments and single family houses. And if you look around, drive around a little bit, you can see all the construction still moving at a pretty high rate.
that's right.
So to me, it looks like we're kind of coming to a head here. If all of a sudden the demand drops and interest rates go up and values go down, what's going to happen next? Well, it's probably going to be an oversupply of houses, which is something that we haven't seen in the last couple of years.
That's exactly right. And as we're recording this, by the way, it's Valentine's Day. We're recording this. Happy Valentine's Day to everyone. I hope you have a great, great Valentine's Day or have had a great Valentine's weekend, however you guys did it. But to your point, Steve, mortgage applications are up over 8% over the past few weeks. That is
Is that new applications or is
those
that refinance
those are
applications?
those are new applications, and that's
Wow.
that's that rush I was mentioning earlier. The Fed did not increase those rates, and people are like, let's take advantage of this before they do it. That's
Mm.
creating that rush to the doors, of the mortgage world. Get as many sold before the rates go up. They're still going to sell some after the first, possibly even the second. They're still going to sell houses. I mean, that's not going to stop. But as those rates go up slowly, those values are going to have to peak and then potentially even come down slightly. They're just going to have to. And that's where we find the opportunity.
Well, that's what we were saying earlier. When the rates are down so low, that pushes the value of the houses up because people can afford to pay more, And if the rates go up, then the value of the houses have to go down to balance that equation.
So let's listen to what they have to say about, a couple different aspects of these opportunities.
It says real estate crisis, 6 million homeowners in forbearance. Very sad. Before they can receive stimulus money, forbearance means they need to re-qualify for the loan. They don't just get the money automatically. They have to re-qualify. If they lost their job or lost their credit, they may lose their home. So in other words, if you lost your job in this COVID crisis, which is fake, and you're losing your home, it's in forbearance, but you've lost your job, the bank's still not going to give you the money. Well, it's not like it's automatic. And then it's an opportunity to investors. It's sad news for homeowners and businesses and the country. Because if 6 million people are homeowners in America are in forbearance, that's a lot of people.
That is an enormous amount of people, and it is what it is. We as real estate investors, I mean, these people took these forbearances. They lost their jobs. They weren't making money. They took these forbearances where the banks knew that these folks weren't going to be able to pay back, $10,000 in 6 months. If they couldn't make their $2,000 payment,
Right.
now you want to make that payment $3,500, to catch up. Where's that money coming from if they're having a hard time finding work? Where is it coming from? So it's almost as if they've just set them up for failure. Like, okay, we're not going to foreclose on you. We're just going to keep, adding up the money. And oh, by the way, we're only going to give you this much time to pay us back. That much.
Yeah.
So
It
figure
sounds
it
like a
out.
rug pull.
Say that again.
Sounds like a mortgage rug pull for
Oh,
those
absolutely.
guys.
I mean, and how are they to know? Because they're not in it. I mean, we're talking about, your everyday average working class Americans. We're not talking about savvy real estate investors that are, looking to maneuver left or right depending on the circumstances, right? We're talking about regular, everyday average working class Americans that this is happening to. And they simply don't know what to do. They don't know where that extra money is going to come from. And they start, doing, once if they have a job, they know they need to make more money because the job they had was enough for them to pay a $2,000 mortgage, not a $3,500 mortgage. So they start making different decisions. They start trading more time for more money, less time at the house they're trying to save, right? Less time with the family they're trying to keep shelter over. And it's just this ugly thing that pushes people right into, a rental market. It just pushes them right into a rental market.
Exactly. So what does that mean for us as real estate investors?
Well, for us as real estate investors, as I mentioned earlier, I mean, it puts us, I think, Steve, in a very precarious situation where it's okay. You're taking advantage of the people in this bad situation so that you can make money. But it's not just that we're taking people. I'm talking specifically about subject to opportunities, right? We're helping these people save their credit. Whatever monies they had in this thing, they've already lost it because they couldn't pay it, because of the, potentially the depreciated value of the home because of any market conditions that may exist at that time. But we know that they're behind on their mortgage. That means legal fees. That means late fees. That means, higher interest in some cases. And then the accumulation of the missed payments. All those things, in one big ball, and for a lot of people are just far beyond whatever they even put down on the house that they may have been saving up for 5 years to do. And now they're not going to be able to pay it back in 6 months. So that's where folks that do either they're buying houses, that are in those situations, or they're taking them over subject to, that saves that person's credit. They live to see another day, and it's easier for them to get into a rental property. But for us, Steve,
But why would we as investors want that house? Because now there's a bunch of cash that has to be paid out to straighten that out. People are going to need money to move, and they're going to need money to pay back the forbearance. So some of those people thought the forbearance was, oh, I don't have to ever pay it back. And no, it means we're just going to let you skate
That's
for a
right.
bit. We're just going to keep it on there and add it up. But so why would we want to do that when now the value of the property's gone down? It's probably negative equity situation. So
Hmm.
what's in it for us as investors?
Well, from my perspective, it's cash flow because we're going into that. We're not in it for an equity position, but we are in it for the future position of equity, right? So we know that rents aren't going down, right? The only way that's going to happen is if people are leaving your town. Even if the home values come down, we're still going to watch rents go up 2, 3% a year, sometimes even more than that, right? I mean,
Yeah.
there are situations that I'm familiar with where people's rent went up $400 from 1,300 to 1,700 in a single year, and that is a deal breaker for a lot of folks. But the point I'm trying to make is we know rents are going to go up. We know that. And we know that we have opportunities out there to owner finance that property to someone. We can uh, rent it out potentially just as a regular rental, or we can Airbnb it. I mean, there's a ton of different options for us to make money, but we're playing the cash flow game. We're making,
So
we're,
as usual, we're looking for the gaps in the market.
absolutely. We talked
So
about it in the beginning.
yeah.
What would we rather be wholesaling? Would we rather be fix and flipping than, managing some kind of a rental portfolio? Some type of an asset that we're holding? Yeah, we probably would. But by doing that, by taking advantage of the cycle today, it sets you up for huge paydays 2, 3 years from now. Huge paydays. Huge paydays.
What you just spoke of is what would we rather do, and that's really more of our personalities.
That's for sure.
But I've stepped back from that a little bit, and I've said, hey, you know what? There's other people who love to do the things that I don't like doing,
That's right.
and so it's pretty easy to hire them like property managers.
That's for sure.
And so to me, at this point, it doesn't matter, whether I'm wholesaling something, fix and flipping. I don't really want to fix and flip anything right now because how do you manage those costs? I don't know how. And come out of it, and getting labor these days is a real challenge. And we talked about material costs. We didn't even talk about the labor costs, which have gone up significantly as well.
Mm-hmm.
So that's a real challenge. So again, what you said earlier was the marketplace is going to dictate which way we move. And so to that point, moving into something that's already fixed, we don't have to deal with the material costs. We don't have to deal with the labor costs. All we have to do is deal with fixing the financial end of the business, and then having our imagination on the other side of it was, okay, now we have the house. What do we do with it?
Yeah, it's always what's next, right? So what's next, and where are we going to go? And I thought that that Robert Kiyosaki and Ken had an interesting take on where it is to go. So let's check that clip out real quick.
Okay.
These businesses are going to leave the non-anchored groceries. As an example, these malls are already big companies taking a look at these for redevelopment into a multifamily, and they're looking at some distribution and things like that. Even corporate headquarters, we're starting to see already this happen. You're going to see multifamily in certain growth markets where people are going and where jobs are going. We're already seeing, for example, Oracle moved out of California to Austin. That's a massive, massive real estate play. Yes, it's big news, but it's really big for Austin, especially in the area around wherever they're going to move.
So, we are seeing that already. We've been witnessing that, over the past couple years. Really, in the past year, we've been watching these companies, certain companies like BlackRock, flex their muscle. You know what I mean? And come in, and Zillow had a problem, and they came in and they bought 7 or 8 thousand houses from them just in one fell swoop, right? And as we know, Zillow made some pretty bad um, acquisitions decisions.
Yes.
You know what I mean? Pretty bad, pretty bad. But but these
And to
companies that
that
are
point,
mhm.
what you're saying there is, you and I are in a pretty unique situation being in the metro Atlanta area where there are a lot of large corporations and companies and hedge funds and investment companies and REITs coming into Atlanta to pick up a lot of this real estate. And so, we see what's going on with the multifamily and the rise in prices in real estate. And, Southeast is kind of known for really great values in real estate. And I've always kind of sat back and thought, wow, Atlanta, why aren't the prices higher? And, well, now I'm seeing that, well, prices are going up. Between all of the industry coming in here, it's just cheaper and better to do business here than it is in California.
Yeah, for sure. And there's a million reasons as to why that is, but um, you know, it's
Or
geographical
all in the mix.
location, right? It's geographical location. It's a global hub. You can get anywhere without necessarily having to. Definitely in the United States without having to catch a layover, so you can just get in and out. I mean, there's a lot of good reasons to be in the Atlanta metropolitan area by itself, but the southeastern region as a whole is feeling that. Texas is getting it. Arizona is getting it. Do you know that there is about a 4 million home shortage in the state of Arizona? They have not been preparing at all for the boom that they've had over the past 10 or 15 years. But
I
that,
didn't know that. I
yeah,
know the market's hot. I
yeah,
know it's
again,
super hot in Arizona.
yeah,
I
it's
don't I
about
don't mean the temperature. I mean the
it,
real estate market.
in both ways,
Yeah.
literally and figuratively.
But
But it's
there's
unique.
no humidity, so you can't really tell it's hot.
Oh, I beg to differ. Woo. Any place you go that has a heat advisory for your pets, I don't know if you want to live there. I mean, it is hot,
Yeah,
super hot.
right.
But yeah, man. I mean, that's where we are. The state of the real estate union today in 2022 is in January 2020, or excuse me, February 2022, is that we are at a precarious place. We are at this tipping point, and it's not gloom or doom. It's where's the opportunity as a real estate investor, and following that opportunity and understanding the signals, the signs that will tell you what to do, because you don't want to run around here uh, trying to fix and flip houses when values have fallen already, right? Unless you're getting an absolute steal, because you have to make sure you can sell that property. We saw that, in 2008, people were, you know, doing or at least trying to do the same thing that they'd been doing before until everything just dried up. But you have to move with the markets. You have to understand when it's time to play the short term game and when it's time to play the long term game, and how that
You can't,
benefits you.
right. You can't be a one-trick pony in real estate investor. You have to get your education about what to do in certain specific situations. In other words, if you're just a wholesaler in this market, you're probably suffering, big time.
Yeah.
So, and if that's all you have in your toolbox, then you need to go try different stuff. That's all. You need to learn as much as you possibly can. And hey, look, I've been at this for a while. I'm going to a seminar myself next week.
Mm-hmm.
I want to. There's always a little nuance here and there to pick up, and there's only one constant in the universe anyway, and that's called change.
That's right.
So let's just get rid. Just accept. Hey, it's going to be something's going to change. It's always going to change, and you might as well get as much education as you probably possibly can. And hey, this is out of state. I'm not. It's not that expensive to go, but I'm going to have quite a few $100 in it by the time I get there and do a hotel and all that stuff. And Miles, I think you're going with me, right?
That's correct. And I got to
Yeah.
tell you, yeah, absolutely. So, you know, to Steve's point, guys, on the way out, you have to be able to understand what's going on in these various points in an economic cycle. That is why there is so much benefit to working with, a mentor, a coach, or whatever, because they've already been through it. I'm not saying you got to come and work with us. Of course, we'd love that to be the case, but you have to find someone that fits for you. And if you haven't lived through this an economic cycle, down point, and how you can figure out how to balance that. I mean, and when I say live through, I don't actually mean live. I mean financially, economically lived through it, where you were putting up dollars and receiving dollars through it and understood those things. If you're in it right now, before it gets too bad, and when I say bad, I mean before it shifts to a place that is unrecognizable to you, get yourself a mentor, get a teacher, and take full advantage of that information and experience they have, because that's going to help you navigate your way through any shift in an economic cycle so that you can always take advantage of it and not be in feast or famine mode, because no one wants to be in feast or famine mode.
And there's not really a template for subject to or wholesaling or renovating or Airbnb. There's not a template. We have regular generic type contracts, but when every time I write an offer, I'm writing something different in there to adjust for that particular situation. So that's the type of flexibility you need as an investor, so you can look at the situation. You can't go in and say, I'm going to do this. You have to listen to your people. They tell you what it is their situation is, and we're problem solvers. Period. End of story. That's it. But you got to know what the problem is before you can solve it.
Amen to that. And on that note, guys, we're running up against time. We appreciate you for watching. If you're on YouTube, for listening. If you're listening on whatever podcast platform, reach out to us. Hit some of the links in the description here. We're going to put a link to this video, this Robert Kiyosaki and Ken McElroy video, because I think it's important that you watch the whole video. So we look forward to working with you in the future, potentially, definitely in communicating with you for whatever your real estate needs are. This is your man, Myles.
Hey, this is Steve Conley. Thanks for watching. #unemployable.
And we'll see you next week. Peace.